So the money side, when the inflation hits, money tightens, all those kind of things, what does that mean to real estate investors? You know, we need to be in debt, we need to leverage, we need to do it right. We need to find the easiest, fastest, cheapest money, no matter what. Since leverage is such a huge part of real estate investing, we want to know what's best when inflation hits. How do you take advantage of it? When money tightens, where does it go? Who do you look for? That's what we're going to go through today on this video, is actually where to find the money. When the prices go down, we need to have the money to actually take advantage of this, to create that wealth. That's what we're going to go through today.
Money, 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 hard money, Mike. Money for real estate investing. Let's make money, 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 hardmoneymike.com.
Hey everyone, it's Mike Bonn, and today we're going to go over the money side, what happens, what's been happening, and what will happen as money tightens. So first of all, what does it mean when money is tightened? So the Fed, as we've all probably seen, heard, started raising their rates, which is what they lend and how they lend to banks. But how does that affect us? It affects us in many ways as real estate investors, because we need debt. We need to keep a lot of leverage. That's how we make money. Number one, we know when things tighten up, the interest rates go up. The money supply is their whole factor here of shrinking it, which means there's less money available. So over the last 8 to 10 years, we've seen hedge funds, pension funds, everyone rush into this industry and make it easier, make it cheaper, make money available everywhere. Those things are starting to decrease, which means you're going to see less money available. It's going to be less competition out there because they can't qualify. Everyone, like we've seen about 20% of the hedge funds, some of the larger funds, already back off. Some just get out of the space because they do not know where the property values are going. Since they base everything on property values, they're going to stop lending as much. We're going to kind of go through some of the requirements that they are now looking for. But just remember, as the Fed tightens everything up, as rates increase, their whole goal is to make the money supply less available, a smaller money supply. That means there's going to be less money for everyone. Those who are money prepared, who are qualified, are going to be the ones who take advantage of this upcoming market. We want to be running in when everyone's running out of the real estate market, because that's where prices are low, and we have to have the money to do it. We have to have the leverage. We have to have the right debt to do it, to get in now and then flip it when interest rates come down, to really grab onto that wealth. So that's what we're going to go through today. Tightening is happening, money shrinks. What does that really mean? Loans for real estate investing during inflationary times. Like I said, what we've seen in the past, 5, 6, 7 years is a lot of different money coming in from overseas, from pensions, from hedge funds. They were all searching returns and good returns, so they all came into the real estate investing world. And so money got cheaper, LTVs got higher, all those kind of things. What happens when everything tightens up, when everything they have more options now. So they may be taking some of their money and putting it into other items. This pool is shrinking. That means there's going to be less money for everyone in real estate investing. We are going to see hedge funds back out of this, banks, just because of what the Fed is doing. They're requiring more reserves. They're requiring more things. So some of the banks are actually backing off. We as private lenders see more and more. We have at least 5x the number of calls of people who used to be bank approved. Now the bank stopped lending to them or lending them as much, so they need some more money. They may need some gap funding. Understand, since the pool is shrinking, those who are money prepared, so all those who are bank clients, who actually got approved through banks and they're not using hard money, they're now coming down to hard money because that is their option during this time. Hedge funds are going step back a little bit. There's going to be less there. The banks are required to step back. Private lenders are going to have more options. They're not only going to do fix and flips, but they may do some loans for clients who used to be bank clients. You need to understand, get a list, start expanding your list of not only traditional, from the hedge funds, the Civics, the Finance of Americas, to your private lenders, to banks. You may have only worked with 1 or 2 banks. You have to expand that now. Maybe have 5 or 6 to make sure they're lending, make sure they have the money. Even private lenders, as things slow down, they're not getting their money back as fast. If they're not getting their money back, they're not putting it out. So expand who you could borrow from during this time. That's one of the key things. And we're also going to look at some other options that are non-traditional, non-bank here in the next couple sections. So just quickly on the money side, what's happening out there? What does this look like in real terms for real estate investors? So what you're finding is almost all lenders are lowering their loan to values, which means you're going to have more money into each transaction. Loan to values are going down. Credit score requirements are going up. Minimum 20, 40, sometimes 60%. Loan to values are going down, credit scores are going up, means that there's less and less people who could qualify for that money. They're requiring more experience. They're requiring properties that actually are in better areas. They're getting away from some of the smaller communities, focusing on the MSAs. On the other side, they're actually opening up other products. For the last 4 or 5 years, everything's been a refi boom, a mortgage boom. So they focused on a 30-year fixed. But right now, there's other options out there that were here before, and they're coming back. That's the ARMs, the adjustable rate mortgages. The benefit of an ARM is it's usually only fixed for 5 to 7 years, and then it becomes adjustable after that. But during that time, you could get into a property typically with a half to point less in interest rate than a 30-year. So it's a way to help your cash flow. They're also introducing more and more interest-only loans on the long-term loans, and that typically looks like for the first 10 years, all you pay is interest, no principal. The benefit, again, is cash flow. You're going to get better cash flow because you're not paying down on a loan. And that works for some people's strategies, and it doesn't for others. But if you're looking for cash flow, getting into properties now, and maybe refinancing later, it is a great option. Another thing that we see trickling in, maybe not coming in as fast, is the 40-year AM. So instead of 30 years, it's 40 years. So they're stretching that out a little bit. That just means that your payments are going to go down. Once again, it's about cash flow. If you're looking at cash flow, getting into properties when everything is down, look at the ARMs, look at the interest only, look at the 40-year amortizations. That will allow you to get into the properties, and if you want to reposition later when interest rates come down, it may be a couple, 2, 3, maybe 5 years out, who knows. But when they come back down, you can refinance them into a traditional product, but you have to be ready right now. Property values are coming down. This is the time to buy. You need the money. You need to be able to adjust. You need to be able to say, like, this is the new normal, and be able to work with these terms, work with these lenders, get as many lenders as you can that actually understand and can fund these loans. Be prepared. Take advantage of what's about to come about. So you got to look at different options too. I mean, your whole goal here is real estate is creating wealth, creating income. We've been on a traditional path. You have to start looking at some of the options, the different things that people have used in the past to actually get into real estate to create wealth that maybe are out of favor in the last 3 or 4 years. So you need to look at these different options, and get prepared, which means get some money into your account, get your, set up right now your HELOCs in your homes while your values are still high. All those things. We've talked about this and we keep talking about this over the last month or two of videos because this is the time, this is what's changing. Stuff like subject to mortgages, like buying property subject to keeping the other person's mortgage. You have to look at these things. These were very popular for a long time, but when anybody could sell their property for any price they wanted to, they never had to look at this. They never had to sell that way. But the reality is, prices are coming down. So if someone bought a house for 100% financing, and now the prices came down 10%, and maybe there's some repairs and stuff that are needed, they can't afford to sell it without bringing money in. And a lot of people don't have the money to bring in. So now they're willing for you to come in, take over the mortgage so they don't go into collections, so they don't go into foreclosure, all of those things, because the market has changed. You need to change with it. We also see that more and more people are interested in owner carries, meaning they sell the property. They might own it free and clear, and they will carry the mortgage instead of going to a bank, instead of going to a hard money or traditional lender. They carry the note because they're going to get a better interest rate than they are at a bank. They don't want their real estate, they don't want their money coming from real estate into the stock market. So that's what they're looking for, is a better secured return, and they could do it by putting the mortgage, the property that they're selling to you, in a mortgage that they carry. So it's a win. You don't have to worry about your credit. You don't have to worry about income. You don't have to typically even worry about putting money in because they're carrying everything. It's a win-win situation. They get a better return, you get a better product. Easier, faster, cheaper money. You also have to look at, as things change and everything, is looking at partnerships and aligning yourself with even, what we call real OPM, because you're going to need, we talked about this earlier, LTVs are coming down. That means you need more money. So if you take some money out of your HELOC, that's great. But sometimes when there's so many opportunities, when prices go down and you want to jump in and buy 5, 10, 20 homes, you're going to need other people's money. So there's a lot of people out there who have money, who are looking for better secured returns. You got to remember everyone in the US is being pinched a little bit because of inflation, gas prices, everything's going up. And if they're still making the same amount or the stock market's driven them down, they're more receptive now to maybe putting some money into a secured real estate note that you could borrow from. From borrowing from a relative or a friend or someone in the industry is a lot easier than actually going to a bank. Their money is actually loosening up when banks are tightening up. So you got to look at other options. You got to be able to look at the subject twos, the owner carries, the partnerships, and the OPM. This is the time to expand, to understand the different options than just the traditional things that have worked over the last 5, 7 years. So I think it's important if we talk about these partnerships, if we talk about the OPM, it's really like, how do you find and create these opportunities with other people's money? How do you make it worth their while? For the last, since 2008, so the last 14, 15 years, this is exclusively what we've done. Work with other people's money to create notes, to create partnerships, all those kind of things. What are some of the tricks? Because a lot of people, understand you need money to be in real estate. It just does not have to be your money. You could make a partnership. You could create these things with other people and benefit both sides. That's the number one thing to make this successful, is make sure you're taking care of that other people's money as they would you. So if you go to a family member and say, hey, you have some money in an IRA, would you like a better secured return? Or anybody out there that is looking for a better return, if it's in an IRA, if it's just in a savings account, or maybe they want to take it out of the stock market. But for them to feel comfortable, you need to be set up. You need to make sure you are understanding your plan, you're understanding your numbers, you're not guessing. And you're also taking care of their money like it's yours or even better. You're making sure you don't skip any steps. You make sure you get their money secured by the property, that it's in a good position. You're giving them a good return. You're paying them on time. What this does is it creates a bigger pool, because if you're doing right by them, they're going to help you find other people. But if you don't do right by them, they're not going to give you any more money or help you. This kind of money, when traditional lenders are asking for, lower loan to values, which means more money in your pocket, this money is crucial right now. This is where you're going to be able to get to that 5x, 10x the number of properties, is by using other people's money, but making it a win for them, making it a win for you. So if you have any questions on that, we've done literally thousands of these kinds of transactions. So we'd be willing to help. We'd be willing to set something up, make sure that they're in the proper position, you're in the proper position, all those kind of things. So reach out to us. We'd love to be able to help you with that, but it is something you need to look at and do wherever you're at, because having the cash, the other people's money, having the banks, having the private money, and as much as you can during this time, and being prepared for when prices come down. I mean, the prices haven't come down quite yet, but they will. I mean, after you go through a winter season and people aren't selling their properties, things are going to come down. Opportunities are there. Rents are still high. Cash flow can be there if you get the cheaper, easier, faster money. Now, since real estate investing is over half the leverage, the money side, we need to get you in the right debt. What we've found over time is that most people just don't understand the money side, how to get that faster, cheaper, easier money, how to create a portfolio of lenders from banks to hard money to OPM. So we came up with this great challenge, this 30-day challenge. And what it does is it helps you understand some of the terms. It helps you actually create your portfolio of lenders. It gets you that up on everyone, and it does it quickly. So within 30 days, you could be light years ahead of where you're at now and your competition. So if that's something you want to do, understanding that leverage is a huge part of this industry, just check below. We have a link, and you could join us on a 30-day challenge, and we will see you soon. We hope you make a lot of money this year, and we know you'll make a lot of money next year.